let's switch over to talk about oil. It's had its worst day yesterday since 1991. You are an investor in the sector through this Occidental Petroleum deal from last year. You put in $10 billion,
Exactly.
I think, and maybe some more after that. I know you get preferred dividends, but that investment has to be underwater at this point. And what's your thinking?
Well, the 10 billion is a preferred stock with warrants, and there is no market in it.
Okay.
I mean, no, it's a private deal. But we also have about 2% of the common stock, and that's down significantly. And you know, as I said when I did it, I mean, the biggest variable is the price of oil, and I don't know the price of oil, and every day it gets quoted. And today it's, you know, quoted at whatever it is on WTI, maybe it's $33 or something like that. And now it's going back into what they call contango, you know, where the far out sells at a premium, where it was in backwardation when we did the deal, and the far out was at a discount. But there's still, you know, if you have an opinion on oil, you can buy or sell oil either 1 year out or 2 years out or 3 years out or something of the sort. And when oil was in the 30s, there's a lot of agony in the oil patch. And the math just changes terrifically. I mean, it just doesn't pay to drill in a lot of areas. And the Saudis can turn out a lot of it with practically no operating costs, or, you know, I mean, they've got very, very, very cheap operations.
I mean, between that war between the Saudis and the Russians, and then also perhaps the secular decline of demand given concerns about climate change, is this really a great place to invest?
Well, I don't think the secular demand will change that much, but certainly the immediate demand has changed. I mean, the airlines need less, and people drive less if they're working out of their homes. And you can change, you know, when you're talking about something close to 100 million barrels a day, if you change it by 5%, you know, that is huge. If everybody wants to keep producing what they were before. And it's, you know, it's what they call the marginal barrel that determines price. When I took economics in school, they used to talk about the marginal mine in gold, and that was a very big deal. And my professor said that he wanted to buy the marginal mine. Somewhere over in Africa, they have a little tiny mine, and it would have a big sign that said marginal mine, and the whole world would watch it. Well, that's what we do with oil, except we're talking 100 million barrels a day. And small supply or demand changes can have a very disproportionate, well, it's an appropriate change in price. And it does correct itself over time. I mean, you know, there's that line that the solution to $25 oil is $25 oil. I mean, people quit drilling then, and that doesn't affect the Saudis much, because they don't have to drill to turn up production that much. But if you get into the shale projects, I mean, the math really changes on them depending on prices.
Both a Berkshire and Occidental shareholder, I was encouraged to see your investment in the company, but with passing weeks, it became evident that your investment facilitated Occidental management's ability to avoid a shareholder vote on the Anadarko acquisition, a very shareholder-unfriendly outcome. This deal proved to be irresponsible and expensive from an Oxy perspective, and ultimately very value-destructive for Oxy shareholders. In my view, it also permanently hurt Berkshire's reputation in the marketplace. Please comment on this unfortunate outcome and tell me why Oxy shareholders and other market observers shouldn't feel this way.
Well, we said right from the beginning, although we didn't certainly expect to agree to it, what's happened. We said essentially, when you buy into an oil, a huge oil production company, you know, how it works out is going to depend on the price of oil to a great extent. It's not going to be your geological home runs or super mistakes or anything like that. It is a investment that depends on the price of oil. And you know, when oil goes to minus $37, it happened the other day for I guess it was the May contract. You know, that's off the chart. And if you own oil, you should only own oil if you expect these prices to go up significantly. I don't know whether they'll go up significantly or not. We're in the transaction. Our commitment was made on a Sunday when the management of Anadarko favored Chevron, and Chevron had a breakup fee of $1 billion, and Occidental people have been working on it for several years, and it was attractive at oil prices that then prevailed. And it doesn't work, obviously. It doesn't work at $20 a barrel. It certainly doesn't work at minus $37 a barrel, but it doesn't work at $20 a barrel. And everything the oil companies have been doing, whether it's Exxon or Occidental or anybody else, it doesn't work at these oil prices. That's why oil production is going to go down a lot in the next few years, because it does not pay to drill. Now, that's happened at other times in the past, but the situation is, you don't know where you're going to store the incremental barrel of oil, and oil demand is down dramatically, and for a while the Russians and the Saudis were trying to outdo each other in how much oil they could produce. And when you've got too much in storage, it doesn't work its way off that very fast. Now, you will have production of oil go down in the United States significantly. It does not pay to drill in all kinds of formations that it paid before, and it doesn't pay to have paid the price that oil was trading at in the ground a year or two ago. And to that extent, if you're an Oxy shareholder, or any shareholder in any oil-producing company, you join me in having made a mistake so far in terms of where oil prices went, and who knows where they go in the future.
Let me follow up with this one then. This one comes in from Manish Bal, who says, is there a risk of permanent loss of capital in the oil equity investments?
Well, there certainly is. There's no question. If oil stays at these prices, there's going to be a lot of money, a whole lot of money, and it'll extend to bank loans, and it'll affect the banking industry to some degree. Not, it doesn't destroy them or anything, but there's a lot of money that's been invested that was not invested based on a $17 or $20 or $25 price for WTI, West Texas Intermediate oil. And but you can do the same thing in copper. You can do the same thing in some of the things we manufacture. I mean, but with commodities, it's particularly dramatic. And farmers have been getting lousy prices, but to some extent, the government subsidizes them. I'm all for it, actually. But if you're an oil producer, you take your chances on future prices, unless you want to sell a lot of futures forward. Oxy actually did sell 300,000 barrels a day of puts, in effect, that or they bought puts, and sold calls, in effect, to match it, and they were protected at $10 for a layer of $10 a barrel on 300,000 barrels a day. But you're really buying, when you buy oil, you're betting on oil prices over time and over a long time. And oil prices, there's risk, and the risk is being realized by oil producers as we speak. There will be, if these prices prevail, there will be a lot of bad loans and energy loans, or bad debts in energy loans. And if there are bad debts in energy loans, you can imagine what happens to the equity holders. So yes, there's a risk.